Welcome to this Friday capstone deep dive. Imagine you and I are just standing at a whiteboard together.
Yeah.
We're erasing all the noise, all the frantic headlines of the week, and we are looking strictly at the hidden variables driving the systems around you.
Right. Getting away from the panic.
Exactly. If you're joining us to make sense of the chaos, you are in exactly the right place. Today's mission is to basically pull back from the raw emotion of the daily news cycle, calm things down, and identify the actual architecture moving the global board right now.
It is so important to establish that calm, high-rigor tone before we even get into the weeds.
Totally.
Because the raw data we are looking at today, it could easily make someone panic if they don't see the underlying structure.
Right, and we have a really fascinating stack of sources on the whiteboard today to help us build that exact structure.
We really do.
We're pulling reporting from Reuters and Nextgov. We are looking at economic calendars from the Bureau of Labor Statistics, the U.S. Treasury, Scotiabank, and the Energy Information Administration. And then to kind of round it all out, we're bringing in forward-looking schedules from MacRumors, the UN Security Council report, and StockTitan regarding NVIDIA.
Looking at that stack laid out, it might seem like a totally random assortment of shipping news, tech blogs, and bureaucratic PDFs.
It sounds like a mess.
Right, but the common thread is incredibly clear once you know what to look for. We are stripping away the emotion and focusing strictly on the mechanics.
Okay, let's unpack this. The biggest hidden pattern this week, the core thesis we need to start with, is that the concept of price is moving upstream.
Yes.
The real action right now isn't in the markets themselves. It's not in the physical asset.
No, it's not.
The action is happening entirely in what we are calling the risk pricing layer. We're talking about insurance clauses, procurement templates, legal authorities, and macro release calendars. That is where the game is actually being played.
If we connect this to the bigger picture, it validates why we need to stop obsessing over the minute-by-minute charts of what assets are doing. We have to look strictly at the permissions that allow those assets to trade in the first place.
I have to push back on that just a little bit, though.
Sure.
Because, if I'm a trader, or even just someone looking at my retirement account, the price of the asset on the screen is ultimately what dictates my reality. How can you say the action isn't in the asset? If oil spikes, oil spikes.
It's a fair point. But think about why the price on the screen moves.
Okay.
Let me give you an example from a few years back. I was tracking a situation where a massive cargo of industrial components sat idling at a port for 3 weeks. The physical asset was perfect.
Right.
The buyer had the cash. The seller wanted to sell. The physical world is totally fine. But the ship didn't move because of a missing signature on a secondary insurance boilerplate regarding liability for a specific shipping lane. The entire multi-million-dollar transaction was paralyzed by a piece of paper. So the asset is just the passenger. The institutional permission layer is the vehicle. You literally cannot price an asset until you understand the permission structure surrounding it.
That makes a lot of sense. So while everyone was watching headline assets this week, staring at oil charts, mega cap tech stocks, and interest rates, the real friction was happening in that boring bureaucratic plumbing layer.
Exactly.
Let's do a quick recap of the deep dives we've done earlier this week. We talked about how the Strait of Hormuz wasn't actually a story about the supply of oil barrels. It was a duration story.
Right.
We saw pricing power show up as a structural asymmetry in liquefied natural gas and defense procurement.
And we have watched a geopolitical shock transmit itself not through military action, but through insurance markets.
Yeah.
The market didn't reprice because the physical world changed overnight. It repriced because the underwriters changed their memos.
Let's read a specific receipt on that to make it concrete for you listening. On March 3rd, there was a fascinating Reuters report explaining that the United States government instructed the Development Finance Corporation, the DFC, to offer political risk insurance and financial assurances to ease Middle East crude shipments.
Which is huge.
Right. So the response to a geopolitical shipping crisis wasn't just to, send more destroyers to escort the boats. It was a state-backed insurance support concept.
That is the perfect illustration of the risk pricing layer in action. The government realized that the physical safety of the ship was irrelevant if the private insurance market wouldn't underwrite the voyage.
Yeah, if they won't insure it, doesn't sail.
Exactly. And we see the exact same mechanic happening in the technology sector right now. Take the piece published by Nextgov this week, focusing on procurement law.
Right, the piece about AI vendors.
Yes. They laid out how alternative contracting methods, specifically other transactions and federal acquisition regulation or OFR pathways, dictate precisely what AI vendors can restrict when they signed government contracts.
Wait, give me a real-world example of that. What does a restrictive FR clause actually look like for a tech CEO trying to sell an artificial intelligence tool to a federal agency?
All right, imagine you're a startup founder. You have built the most advanced predictive AI model on the planet. A federal agency wants to buy it for $1 billion.
Sounds like a great day.
You're thrilled. But then you get to the FR boilerplate. There's a clause dictating data provenance, meaning the government demands the legal right to audit every single piece of copyrighted data your AI was trained on and potentially own the underlying IP adjustments made during the contract.
Oh, wow.
Right. As a commercial CEO, signing that clause might completely destroy your private business model. So even though your tech is the best and the government has the money, the deal dies.
The paperwork kills the tech.
The boring boilerplate template is what allows or prevents a technology from scaling. What's fascinating here is how this completely flips the traditional consensus. The consensus tells you to watch the asset, watch the barrel of oil, watch the tech stock. But the math and the reality of how these systems actually work says you need to watch the thing that decides whether the asset is even allowed to transact.
Right.
In 2026, the leading indicator for the market is not a price chart on a screen. The leading indicator is a memo from an underwriter or a clause in a procurement contract.
So what does this all mean?
It means that sheer capital and liquidity do not fix everything anymore. Institutions themselves have become the ultimate bottleneck.
Yeah.
And once institutions become the bottleneck, price volatility stops being a pure financial story and becomes a governance story. The takeaway for you listening is this. When the next shock hits the system, do not start by asking, what is the price of the asset?
Right.
Start by asking, what is the permission?
That is a critical shift in perspective. And it leads perfectly into another weird inversion we observed this week. We're seeing that magnitude matters less than duration.
Oh, absolutely.
A small disruption that lasts a long time becomes a structural reality. A massive disruption that ends quickly is just a passing headline.
We are seeing a fundamental transition from event risk to clock risk.
Let me try an analogy on that. It's like being in a massive traffic jam. The initial crash, the event, isn't actually what ruins your week. It's the 45 minutes you spend idling, missing your meeting, and burning gas while you wait for the tow truck.
Yeah.
The duration is the actual penalty, not the event itself.
That is a really great way to put it. If the binding constraint on an asset is institutional like an insurance underwriting process or a statutory legal window, then the severity of the initial event is secondary.
Right.
The only variable that truly matters is how long the bureaucratic clock runs. Actuarial timelines and legal windows create their own gravity.
Let's look at international diplomacy to really illustrate this shift to clock risk. We have the UN Security Council report detailing their plan of work for March 2026.
Which is fascinating reading if you look at the structure.
It is. The report explicitly notes how the institutional monitoring of the escalation with Iran operates on its own highly structured, scheduled timeline. It's a bureaucratic clock that ticks away completely independently of the daily panic on cable news.
The headlines scream about a geopolitical event, but the actual institutional response is governed by a predetermined monitoring schedule.
They don't care about the news cycle.
They don't react to the headline, they react to the calendar. And we see these clocks dictating the financial system just as rigidly. We are moving into a period where scheduled data releases become the actual auction house for the price of money.
And the biggest clock of all is about to ring. The Bureau of Labor Statistics, the BLS, announced that the February 2026 Consumer Price Index, the CPI, drops on Wednesday, March 11 at exactly 8:30 a.m. Eastern Time.
Which is a massive ticking countdown for the markets. If you pull up the Scotiabank economic calendar, you can see that next week is completely defined by these clocks.
Yeah, it's packed.
You have the U.S. CPI on March 11, and then you have the preliminary University of Michigan consumer sentiment data coming out on March 13. Next week is an inflation expectations and policy timing gauntlet.
It really is.
Textbooks will tell you that markets price fundamentals, supply, demand, earnings. But history shows us that in transition periods, markets actually price decision points.
Right?
When the broader narrative is uncertain, the exact moment a piece of data is released becomes the singular focal point for capital allocation.
So the actionable habit for you listening right now is to start tracking these clocks.
Yeah.
You need to map out the CPI days, the Treasury auction schedules, and the policy meeting windows.
You have to.
Because in 2026, volatility doesn't just happen randomly out of the ether, it clusters violently around these scheduled moments.
Which brings us to the setup for next week.
Yeah.
We are looking exclusively at fresh catalysts. And the first major catalyst is what we can really only describe as a classic macro ambush.
A macro ambush.
Yeah, inflation prints meeting duration supply.
Before we go further, translate duration supply for the person listening who doesn't live inside a Bloomberg terminal all day.
Fair enough. Duration supply simply refers to the sheer volume of long-term debt the government is trying to sell to investors.
Okay.
When the government runs a deficit, they have to issue bonds, treasuries, to pay for it. If they are issuing a massive amount of 10-year and 30-year bonds, they are flooding the market with duration supply.
I see.
The market has to have enough available cash and enough willingness to buy all of that paper.
Got it. So next week features a collision between the CPI inflation data release and a massive wave of these long-term Treasury auctions.
Yes.
The CPI number acts as one shock absorber, and the Treasury auctions act as the other. Let's list the receipts so you know exactly what is coming.
We have the BLS releasing CPI on March 11. But layered right on top of that, we have the U.S. Treasury tentative auction schedule PDF. And it shows a staggering amount of paper hitting the market.
It's a lot.
We have the 3-year note auction on March 10th, the 10-year note auction on March 11th, and the 30-year bond auction on March 12th.
And to cap it all off, the Scotiabank calendar flags personal income and spending, as well as GDP numbers, dropping on March 13. That is a brutal schedule.
It is. If the lesson of this past week is watch the risk pricing layer, next week is the moment when that entire layer gets stress tested.
Right.
The consensus treats the CPI like it's just a backward-looking economic statistic, a report card on what milk cost last month.
Right. Historically, that's how it's viewed.
Exactly. But right now, in this environment, it is a policy trigger. And a policy trigger can move prices much faster and much more violently than underlying economic fundamentals.
So what's the resolution here? What should the listener be watching as this collision happens?
The critical question is twofold. First, does the CPI print actually move inflation expectations? And second, does the long end of the bond market accept it? We need to see if yields will fall on supposedly good inflation news, or if the sheer supply of Treasury paper hitting the market overpowers the good news. You are watching a real-time test of the market's willingness to finance the government's path forward.
So watch how the 10-year and 30-year yields react immediately after that CPI print on Wednesday, right in the middle of those auctions.
Exactly.
Moving on to our second fresh catalyst for next week, energy forecasts versus reality. And I want to do a clean reset here. We are stepping completely away from the shipping conflict and maritime insurance headlines.
The real energy story next week is not going to be found in a geopolitical headline about a drone strike. It is going to be found in the forecast baseline.
We have the Energy Information Administration, the EIA releasing the Short-Term Energy Outlook, the SETO. The next release is scheduled for Tuesday, March 10th, 2026.
This ties right back into our discussion on duration and clock risk. Forecasts are the mechanism that institutions use to turn an estimate into a financial baseline.
Right.
Think about how a massive industrial manufacturer plans its energy costs for the year. They don't look at a daily news ticker. They look at the EIA's official outlook.
Right, they need the baseline.
If the EIA's forecast bakes in the assumption that a current energy disruption is temporary, the markets will stop paying a premium for it. But if that official forecast narrative shifts from temporary to persistent, suddenly you have a structural repricing across the entire global energy complex.
It changes the math for everyone, from airlines buying jet fuel to plastics manufacturers.
Precisely. People hold on to this myth that energy markets are priced primarily by geopolitics.
Yeah.
While a conflict grabs the front page, the day-to-day reality is that energy is actually priced by inventory math and these institutional baseline assumptions.
So the resolution for you on this one is pretty straightforward. On March 10th, pull up the EIA summary. Don't look at the raw barrel price. Look at the narrative. Does the official forecast lean toward an expectation of surplus and inventory builds, or does it lean heavily toward constraint and persistent tightness? That baseline assumption is the permission layer dictating the price.
Exactly.
Here's where it gets really interesting. We have spent a lot of time on macro concepts today. Treasuries, CPI, supply dynamics.
Yeah, heavy stuff.
Let's introduce a real economy check that completely avoids that world. Consumer hardware and global tech demand. If you want to know if the economy is actually resilient Watch what regular people and businesses are actually buying.
It is the ultimate test of whether pricing power is hitting a wall.
According to a schedule roundup from MacRumors, Apple has new product launches slated for Wednesday, March 11th, 2026. And layering right on top of that, we have a report from StockTitan detailing the schedule for NVIDIA's GTC conference taking place the following week, where CEO Jensen Huang and a roster of global technology leaders will be showcasing new developments.
I love looking at these two events side by side because they are two massive but very distinct signals for the real economy. On one hand, you have Apple. For Apple, the metric to watch isn't the initial stage presentation or the media hype, it is the pre-orders. Those pre-orders are a pure signal of the consumer's wallet.
Right. If milk and rent are through the roof, are people still willing to drop over $1,000 on a new device?
Exactly. Do the pre-orders indicate enduring consumer resiliency and a willingness to absorb high prices, or do we finally see undeniable evidence of demand fatigue? It tells us if the inflation we talked about earlier is actually crushing the end user.
And on the NVIDIA side, it's a completely different check.
Yes.
It is less about the everyday consumer and entirely about watching the institutional clock for the next wave of AI capabilities. It is the procurement side of the economy signaling its capital expenditure intentions.
Yes. NVIDIA represents the enterprise infrastructure side. When major tech leaders gather at a conference like GTC, they aren't just looking at cool gadgets. They are planning multi-billion-dollar data center build-outs for the next 5 years. The hardware being showcased is just the physical manifestation of the permission layer we discussed at the top of the show.
Exactly.
It shows us where the capital is strategically preparing to flow, assuming the procurement contracts and FAR pathways allow it.
We spent a lot of time on Hormuz shipping insurance, AI procurement clauses, and defense spending this week. Here's why we're moving on, and here's what replaces it on your radar.
What replaces those older topics is exactly what we just mapped out, the risk pricing calendar.
Right.
The foundational mechanics of the market are scheduled to reprice over the next few days. Your focus should now be squarely on the CPI data drop, the massive wave of Treasury auctions testing the market's liquidity, and the institutional forecasts, like the EIA report, that dictate our baseline assumptions of how the physical economy works.
If this week was about the risk pricing layer, next week's question is, which business models break first when the price of money moves, and which quietly get stronger?
This raises an important question, and it is something I want you to genuinely consider as you head into the weekend. We've talked abstractly about global shipping and federal AI contracts, but take a hard look at your own industry, your own career, or your personal balance sheet.
Bring it down to the individual level.
Exactly. Think about the hidden permission layer that your livelihood relies on. Maybe it's a specific professional licensing board, or the liability insurance your small business requires to operate, or even the financing clock on your company's line of credit.
Yeah.
If that boring, bureaucratic baseline suddenly shifted tomorrow, if the insurance premium tripled, or the legal boilerplate changed, how much would the underlying value of your actual daily work matter?
That's a great point.
It is a sobering thought, but understanding where your personal vulnerabilities lie in that permission layer is the very first step to mitigating the risk.
That is an incredible thought to end on and a perfect way to bring all of this macro theory right back to the whiteboard in front of us. Thank you so much for joining us for this Friday Capstone Deep Dive. Stay curious, look past the noisy headlines, and above all, watch the clocks. We'll see you next week.